Today, we're going to take a look at what bonds actually are and how we can evaluate them. Let's get started. Bonds, like stocks, are securities and are issued for the purpose of financing in exchange for raising capital. Unlike stocks, which are classified as equity, bonds are classified as debt and therefore represent liabilities for the issuer. The key characteristics used to differentiate bonds are issuer, maturity, coupon, and price. We will now take a closer look at each of these key characteristics. Let's start with the issuer. Bonds can either be issued by companies, in which case they are referred to as corporate bonds. Additionally, bonds can also be issued by governments, and these are called government bonds. Finally, bonds can also be issued by supranational organizations such as the World Bank. So, bonds appear to be a widely popular financing option. Let's move on to the maturity of bonds. Here we can distinguish between short-term bonds with maturities of up to 1 year and long-term bonds with maturities of, for example, 10 years or even 30 years. Such long-term bonds are often issued by governments to secure long-term refinancing. However, the maturity is not capped, which is why government bonds with maturities of 100 years are becoming increasingly popular. Now let's talk about the coupon, which is the interest rate of the bond. Investors who purchase a bond usually enjoy regular interest payments, known as coupon payments, which they receive until the bond matures. Coupon payments are usually fixed, but can also be variable. With European bonds, an annual coupon payment is usually expected, while American bonds often pay coupons quarterly. There are also bonds known as zero coupon bonds, where no coupon payments are made during the term. In this case, the accumulated coupon payments are only paid at the end of the term, along with the repayment of the face value. Next, let's discuss the bond's quoted price. Bond prices are always quoted as a percentage. The face value at which the issuer issued the bond is 100%, and since bonds are usually traded on the stock exchange, this face value is not constant. For example, the bond might be quoted at 90%, which means it is trading below par. Investors who buy the bond at this price will still receive the face value of 100% at the end of the term, making this a potentially attractive entry point. Bonds quoted above 100% are trading above par, and if the bond is quoted at 100%, it is trading at par. Great, now we're familiar with the basics of bonds. However, it's also interesting to be able to calculate the current price of bonds, that is, the present value. Let's take a look at the following example. We have been tasked with calculating the current price of a bond. The bond has a face value of 100 euros and a maturity of 3 years. The coupon is 3%, and our discount rate is 2%. The discount rate represents our discount rate and corresponds to our yield requirements. Normal bonds typically have the following payment structure. Coupon payments are made throughout the term, while in the final year, both the last coupon payment and the repayment of the bond's face value take place. We must discount these payments for each year using our discount rate. Essentially, what we're doing here is calculating the present value. Plugging into the formula, we get $3 for the coupon payment in the first year, divided by 1 plus 0.02 for our 2% discount rate raised to the power of 1 for the first year, plus $3 for the coupon payment in the second year, divided by 1 plus 0.02 raised to the power of 2 for the second year, plus $3 for the final coupon payment, plus the repayment of the face value of $100, divided by 1 plus 0.02 raised to the power of 3 for year 3. The calculated current price of the bond would be $102.08. Great, we can also check off the calculation of bond prices. Now, we are much more familiar with the topic of bonds. We hope this video has helped you understand the topic of bonds. See you next time and have a good one.